Well, question for you both. Does the UK need a growth fund?
Absolutely. We need more capital all the way up and down the stack, from post-IPO to pre-IPO to growth to C, B, A, the whole way, because there is capital at the earliest stages. But if those companies can't graduate to raise follow-on rounds, the market, the ecosystem is not going to develop. And to Sean's point, yes, of course, there's money in the US, but it's always going to be hard from Sand Hill Road to, diligence and pick companies. And yet the very, very best companies, the top, 5% will always get funded. But you do need, to the 1,000 flowers bloom, you do need capital to reach more things and more places for the whole stack to work. So I say absolutely, yes.
Yeah, I think for me, it's like the more interesting part of this is catalyzing the sort of the pension fund or the LP community, because again, you do see lots of capital in the UK, but it being US managers, it's coming like that. Those underlying investors are from the US, that's where the gains are accruing to. And I think like the problem with venture is that it's a very different part of the market to just about anything else. When we talk to people that haven't spent any time there, the first step is basically unlearn everything you've learned about investing in public markets or in buyout funds. This is a very different beast, but it's also a very small niche of the market. So if you've got, your private markets portfolio, of which venture is 10%, you're probably not spending that much time there. And if you're an institution that hasn't done venture before or hasn't done it for a long time, it's hard to go up the ramp. I mean, I've been investing in venture funds for over a decade now, and Vencap as an institution has been doing it for almost 40 years, and we still find it really difficult, and it's all we do. So if you're,
What's unpack that a bit, Sean? What are the challenges, or maybe some success stories and some failure stories without naming names? But unpack that a little bit for us.
I think at a really high level, there's data coming around from Carter. They do a nice job with some releasing their benchmarks, and people have been looking at the performance numbers. And Dave, our CIO, posted this on Twitter, got quite a few reactions. Like the numbers aren't that great. To put it mildly, and everyone knows like the median venture fund.
Carter's mainly US data though, isn't it?
It's mainly US data, and it's mainly smaller funds. And you can look at Cambridge Associates or PitchBook or Preqin or wherever your favorite benchmark provider is. But it's sort of the performance you see in the benchmarks doesn't match up with what you see in pitch decks quite starkly. Maybe if you're in the top,
we're going to do 5x. Everything's 5x, baby.
I've seen people promise 10x on their first time fund. Maybe they will. Who knows?
Did you sign them up? I'm assuming you were throwing money at them.
How could you say no with that sort of projection?
Exactly.
but it sort of comes to the fact that the venture ecosystem is so skewed. If you're not in those sort of top quartile, top decile funds, it's really hard to make it work. And it's sort of very easy to go in, and we've met people that have done this as an allocator. You go into venture, you back a load of median funds because that's what you probably expect statistically, and you say, well, this doesn't really work. So we've taken a load of risk, we've had massive illiquidity, and why are we not just putting this allocation into lower mid-market private equity? So I think like the hard bit just comes through in that performance data, and that's always going to be the case.
Yeah. And I guess bonds are now really attractive, and other vehicles are now really attractive for investors as well. So how do you make decisions? What are the key things that you look for? The things that maybe aren't so common knowledge when you're looking at firms?
Yeah, I think like the way we do the venture world is sort of really quite simple, and there isn't any sort of like magic diligence question or silver bullet that will sort of get you consistent performance. The things that sort of keep on driving the industry at an industry level in terms of performance is those top 1% of exits. It's the top 20, 30 IPOs or M&As of any given year. They tend to be the majority of exit value. There tends to be a pretty small group of VCs that can consistently back those companies. The other interesting sort of component of it is fund returners, where if you've got one company returning at least the entire committed capital of your fund. Again, venture's an outlier business. This would be that exemplified through that. But when we look at our data, about 90% of our funds that are doing over 3x net have at least one. So again, it's sort of, do you think you can partner with the world's best companies, or do you think the manager assessing can? Do they have a track record of doing it, which is normally how we like to look at it? And are they able to do it in such a way where it's meaningful for their fund? Because if you're able to put, a small check into a very late round of a great company, that's a nice logo, but it's probably not going to translate through to fund performance.
Any themes or trends that you're looking at, maybe China, America, India, Europe, UK, any themes or trends that are kind of driving your strategy at the moment?
The interesting thing for us is that we sort of view all these trends, whether it's sort of sector, so lots of investment at the moment into the sort of, physical AI, semiconductors, networking equipment, all this sort of stuff, different geographies, but we're sort of passive consumers of that, if that's the right way to put it, because what we like to do is back generalist managers, and they'll tend to go where they see the best entrepreneurial talent. So it means that you get early exposure to, the LLMs. So we were in early rounds of OpenAI and Anthropic, which we're very happy about, but we had no AI thesis at the time. We were underwriting the funds that did that. So it sort of helps keep us on the front foot in a convoluted way, because we're leaving ourselves open to backing those emerging trends. The same is true for geography. The reason we went to Asia 20 years ago is because lots of our existing global managers said, look, we see a great opportunity. We see the talent. We're not going to say, actually, now's a great time to be, backing entrepreneurs in Beijing or Bangalore, as opposed to the UK or San Francisco. So again, like, we sort of see all these trends, but a lot of what we focus on is just, are you able to consistently partner with those best entrepreneurs?
No, that makes sense. Coming back to this £1 billion UK scale-up fund, what are your thoughts on this specifically?
Yeah, I think for us, and before this podcast, we cut some of the data we've got, because we tend to back established managers. They tend to have larger funds. So if you look at, we looked at the 2010s, so we looked at 2011 through to 2020, we had 17 funds that were over $1 billion. So dollars, pounds, blow your eyes a little bit. It's a mixture of early stage and growth stage. And obviously $1 billion fund investing in 2011 is very, very different in terms of environment to 2020. But just as sort of like a simple cut, what do these funds look like? And the interesting thing is, they're performing pretty well. Like, as a cohort across the decade, it's sort of 2.8x net. So you're almost at that 3 mark. We sort of projecting them out to get roughly in line with that sort of 3.5 times, which is, roughly what we'd expect from this sort of cohort. So again, performing really well. There's, 40% of those funds are over 3x net. There's 2 of them that are over 5x. There's none of them that are losing money. So you sort of look at it and say, well, look, $1 billion funds, they work. This is great. But sort of, when you dig a little level deeper, you see just how hard this stuff is. So on a look-through basis, there's 759 companies. And if you look at the top 5, they're generating about a third of the total value. So right. If you're not,
power law.
It's power law. And if you look at the top 10 companies, that's almost half the value. And these top companies, it's things like maybe a ByteDance coming out of China, a Databricks, or a DoorDash coming out of the US. There's a big slug of OpenAI in there, and these are the $100 billion plus companies. So if you take those out of the sample, then suddenly this is not going to look very exciting at all. And the key thing is, are you able to get into those key companies? And then going back to the power law and the fund returners, there's 8 individual fund returners in this sample. So with those 8 fund returners, it's not that 8 of the 17 funds have 1. It's that 3 of the funds have 2, and there's another couple sort of floating around there. So what it means is that, this cohort has performed exceptionally well, or, pretty well at this point. Hopefully we'll get to that exceptional level, but it means that there's a couple of truly exceptional funds in there, and a lot of them that are sort of, that are doing good, but are fine, but it's power law at every sort of level. So again, when we look at this compared to the, the £1 billion UK scale-up fund, I sort of look at that and say, look, this can absolutely generate and just our returns. Like, the fund size is a bit of a red herring in a way, where if you back the right companies, you can absolutely generate venture performance. The problem is, coming out of a much smaller market like the UK compared to like a global fund, you might have 1 shot, you might have 2 shots. And if you miss those 1 or 2 companies, you might end up being on the wrong end of these sort of benchmarks. And if you get those 1 or 2, you might be a hero. So, that is a tall task, but, no one has ever accused venture of being easy.
No, it's not easy. And the bank is pulling this all together, and we'll see who comes in and who makes the real commitments beyond the commitments to explore, in inverted commas.